Now it will be more natural for me because I will be asking questions, not giving the answers. So I feel much better. Thank you guys for joining us on Impact in Bucharest. It's going to be probably a very nice discussion because we are actually in the moment we call it Crossroads. So we either go to the investment and we will keep the growth, or we will feel the stagnation. So I would like to start from the question how would you describe the current situation? If we are rather growth or inflation is the biggest problem, what are also the biggest differences between the regions? Maybe we will start from the Geoff, and if you could introduce shortly on the beginning, it will be also nice for our public.
Okay, thank you very much. It's great to be here. I'm Geoff Gottlieb with the IMF. The broad story in the region is very similar everywhere. You have acceleration after a very weak year last year, driven by consumption, which is in turn driven by a sharp upturn in real wages. Investment is still recovering, and exports are generally weaker everywhere, driven both by weaker prices and weaker demand out of Germany. This broad story is similar. Romania is a bit different because Romania had stronger growth last year, so it's a bit more similar to last year. But in general, this is what we see: consumption driving a recovery in growth, and then expecting investment to take over next year and the year after. On inflation, we have the worst of it behind us, thanks in large part to a decline in global prices, but also helped by tighter monetary policy. But now we're seeing the final stretch to be quite difficult, driven both by taxes and regulated prices going back to normal, but also sticky service prices. And so this final stretch of the disinflation is not done, but we're almost there.
Nina, how would you describe the current economic situation in the region?
I very much agree with the previous statements. I would just say that there is some heterogeneity, obviously, among this region, meaning that Visegrad economies like Czechia, Slovakia, but also Romania and Slovenia with high automotive industry, of course, more sensitive to what has happened in Germany and its recessionary trends because of the lack of demand for this particular sector. On the other side, we have Baltic economies that are a bit more open, vulnerable to inflation, but all of this is now on a positive trend, and I'm very positive and optimistic that in the future CEE economies will grow above the EU Western EU member states, meaning that convergence will continue for sure. Medium growth, which I think is important, will depend on how this region copes with green and digital transition.
Okay, Maciej, how would you assess the current state of Central Eastern European Union?
Thank you. Thanks for the invitation. I'm from Santander Bank, Polska, from Warsaw. I'm CFO and Chief Economist. I agree with some elements which you mentioned, but maybe to make the panel more interesting, I will disagree with some as well. I think the future growth depends more on German growth and the Eurozone stance, and this is the big question. Maybe we'll have a time to touch upon this later in the panel. To what extent the slowdown or stagnation in Germany is secular or cyclical, whether this is structural. Because if this is the structural problem, I think we face as a region a bigger problem also going forward. I'm from Poland, we are in Romania. Happy to say that next year I think the growth will be the strongest in these two countries, 3.5%. The rest somewhere around 3%, some countries above, some countries below. I think inflation, unfortunately, is the biggest problem and will be in Poland. Core inflation still 4%. And I think the fastest, Czech Republic and then Hungary, they will reach the inflation target. Poland probably much later. Romania as well because of the structure of growth mostly driven by private consumption. I agree that next year the engine of growth will switch into the investment. And the fiscal story, I think this is different as well between the countries, with Poland and Romania under the EDP, with a bit of different strategies to consolidate. But this consolidation path will also affect growth. So Poland 25, no consolidation, still supporting growth. 26, 27, expected strong consolidation, at least on paper. Let's see how this will look in reality.
Ciprian?
Hi, thanks for having me over. I'm Ciprian Dascalu from BCR. So yeah, pretty much agree with what was said. Yeah, the growth across the region was decent this year, but if we look back at the start of the year, basically at Erste we revised downwards the growth forecast for this year for most of the countries. Poland is definitely outperforming, but in Romania we continue to revise it down. We have now 1.9%. It was also mentioned the fiscal issue, which basically it's almost across the region. Several countries are in the EDP procedure. This most likely, I mean, some of the countries started consolidation, like Slovakia or Czech Republic. Some don't plan, like Poland or even perhaps Hungary, due to elections. But some countries needed to adjust their fiscal policy quite significantly next year, especially Romania. We have for Romania next year growth forecast at 2.8. We had included some negative fiscal impulse, but given the starting point with a deficit most likely this year close to 8%, the negative fiscal impulse might be larger, and we might need to revise again lower the growth forecast. Again, the growth outlook for the next 5 years is definitely to be significantly lower than the region has enjoyed over the past 10 years. You have demographics problem, you have almost everywhere tight labor market, shortage of labor force, especially skilled labor force. And if you look at Draghi plan, the competitiveness, and if you look at around the region, usually countries in the region are mostly lagging behind or are significantly below the EU norms in terms of competitiveness. Thanks.
Thank you. What are the biggest challenges for the region? Because from my perspective, if I look at the data, I would call that the low level of investments is the biggest problem. Do you agree, or do you see the difference, Maciej?
It depends in which time horizon, of course. Whether we're talking about 25, mid-term, long-term. I think that the mega trends, well known, will be affecting the region negatively in the longer term, which is demographics. There are some opportunities, which is the energy transition, but I think the overall comment would be that we need to think about changing of the growth model from the labor-intensive to capital-intensive. And from this perspective, the investment growth is a must. So looking at the title of our panel, investment or stagnation, if no investment, probably, well, stagnation for us is 1-2% growth, but we can say this is stagnation. So yes, and this is especially for Poland, the only country having investment ratio to GDP below 20%, which is the lowest. But fortunately, the EU funds, Recovery Resilience Facility, which was mentioned at the previous panel, etc., this will drive the investment in the next few years. So I'm optimistic that this change of the business model for growth will materialize.
Nina, what do you see as the biggest challenges now?
Well, first to say that I think that foreign direct investment was really a game changer in this region upon their entry into the EU as a whole. It has really sped up the growth rate, it has sped up the productivity. These are the data-driven answers. It has also pushed these countries up in the global supply chain. And just to demonstrate to you, over the 10 years, for instance, country like Estonia received over 7% of FDI into the GDP on average. World average is 2.1% for 10 years period behind, and most of the CEE economies accomplished these shares above the world average. Hungary is a bit of an exception. It had over 15% of FDI in GDP for the 10 years average because it's a bit FDI specific economy because it attracts a lot of conduct FDI. It's a topic on its own. But what I think that these economies in the future should do, there is a little bit of a risk of over-reliance on foreign direct investment. It's not just about attracting foreign direct investments, it's about what type of foreign direct investment you attract. And then what are the industrial policies you implement within these economies to benefit the most from foreign direct investment knowledge spillovers, meaning through the supply chain that occurs if local firm supplies goods to a foreign firm operating in that country, or if a local firm purchase inputs from foreign firm. So that's a very likely chain. It was the main, actually, chain, according to the regions, to which this knowledge spillovers effect occurs. But more so horizontally, meaning the local firms learn from foreign firms that compete with one another. Despite the competition effect, they can still learn from each other through labor mobility or certain imitation. What I think in the future should bring is more knowledge-intensive foreign direct investment. So moving away from FDI that was skewed toward assembly of production, towards more knowledge and sophisticated. And that, of course, FDI, and that, of course, requires industrial policy that is protecting intellectual property rights on one hand. So it can actually attract this foreign direct investment. But in the same time, that is working on the level of innovativeness of local economy as a whole, of the private sector. Because at the moment, the private sector is more production-based. It's not like, it doesn't invest much in R&D. So I think this is what the future should bring.
Thank you very much. Ciprian, you were talking about tightening fiscal policy. How can we attract investments in the state of tightening fiscal policy?
Yeah, hopefully, at least in Romania, most of the tightening will be borne by the consumer rather than the companies. I think overall the fiscal climate is not that bad. I think bureaucracy is deterring to some extent foreign direct investments. Also, lack of skilled labor force. I mean, everybody is talking about improving your value-added exports, but when you look, except perhaps Poland and to some extent Czech Republic, if you look at tertiary education levels, even for young cohorts, you don't really find skilled labor force to scale up basically your exports and to bring more value added. But I guess bureaucracy, and including property rights, it's an important factor for direct investments throughout the CEE. You have some advantages for nearshoring and friendshoring, especially in Romania, given low dependency on energy imports. And perhaps with Black Sea Neptune project starting to run in 2027, it will become a net export of gas Romania by then.
Okay. Geoff, how do you see this question? Do we actually need investments? Is it a must for the growth? And what can we do about it too?
I mean, so again, in the spirit of making things interesting, I'll disagree a bit. I mean, I think it is not right to say that investment is too low in this region. I mean, as Maciej was saying, this is mainly a Poland and also a Bulgaria issue. I don't see investment as too low in Czech. I don't see it as too low in Hungary. I don't see it as too low really in Romania. So it's really in those countries, other than Poland, I would emphasize much more productivity and labor issues than investment. So that's point number one. Point number two, the model of investment that we've really had in this region is FDI into the export sector, taking advantage of an educated workforce that is competitively priced. What is changing in the last couple of years is the price of labor. It is becoming less competitive in this region. The price of energy is also becoming less competitive. And in general, what I hear is that people are relaxed about this for two reasons, and I think both raise concerns. The first one is that people hope that more expensive labor is going to drive investment in labor-saving technology, which increases productivity of capital and solves the problem. And I guess my reaction to that is, maybe it will. But the other alternative is that investment will just go elsewhere. It'll go to Turkey or it'll go to other places that remain more competitive on that front. So I think it's really important that these recent increases in wages are matched by productivity. The other reason that people say they're relaxed about this is the nearshoring story. And this idea that with global fragmentation and fears about contrasts in values and political ideology, that capital and factories will locate to this region even if it's more expensive because of the alignment of political values. And again, maybe, but we don't really see that in the data yet. This is still much more of a narrative in the media than we see in the export data or the FDI data. Again, it's early days, and what might happen is that this follows the announcement of protectionism in Europe, that as imports from Asia become more expensive, factories relocate, but as of yet, we don't see it. And again, we think that FDI can remain a big driver, not the only driver, but a big driver in this region because the region is not at the productivity frontier.
Thank you very much. Let's, guys, talk about the region as a whole, because the biggest question from my perspective is if we are competing or we can cooperate. Nina, what do you think?
I would say cooperation. I would go for that. And I would start with Mario Draghi report, which was very recent and brought attention globally. And he has emphasized exactly that. So this is not a problem only for CEE economies, it's for the EU as a whole, that it's so fragmented and that some industrial policies are just not timed up across the member states. Then financial instruments are decided at the EU level but disseminated at the member states. So there is also complementary policies were needed in the times of crisis, meaning some fiscal policy, industrial policies together are not aligned and communicated across member states. So this is all something that I would say applies to the CEE economies too. On the top of that, the research states that regulatory framework and laws in these particular economies that are regulating the rule of games innovation ecosystem. So CEE economies belong to production-based economies. So they mostly innovate incrementally. They do invest in R&D, but below the levels of Western EU member states, just because R&D is a bit more expensive. But one question is why, and one reason is the regulatory framework that designs the rule of games in the innovation systems is slightly complex for small, medium-sized enterprises and startups, which you mentioned, and bureaucracy that my colleagues mentioned too today. So it is demotivating innovation. It's leading to innovation failure. It is leading to this incremental innovation and not R&D, more expensive and breakthrough innovation that is inherent to advanced economies. So cooperation is needed across member states to first homogenize this regulatory framework so that it's consistent across EU member states. So if you export and you're aware of, if you operate in Ankara, you're aware of that regulatory framework ex ante. So I would say that that would also benchmark this region as a whole, as a region for foreign direct investment, because now we are living in the world of more of regionalization. Friendshoring and nearshoring that have been mentioned. So I think cooperation among the CEE member states is something that is needed.
Geoff, how do you see the potential for regional cooperation, or maybe we should compete?
Well, yeah, I guess I would see more of a political angle here than an economic. I think that getting unfettered access to this broader single market of Western Europe is probably more economically urgent than economic cooperation in a vertical sense in this region, because these countries are much more similar in the way that their economies are produced. But I do see a political angle where there's a lot of similar interests in terms of how EU regulations affect this region, and I think there's scope for the region to speak with more of one voice in Brussels, particularly thinking about the financial sector space.
Okay, Ciprian?
Okay, so far I think at least for getting the FDIs you saw some competition.
Exactly.
But
even strong one, I would say.
Yeah. Yeah, I think the countries could find at least a few sectors that they can develop a strong cooperation, like in energy security, energy transition, even defense. I mean, defense means a lot of investments, and basically you have increasing the budget spending on defense, but actually the hardware, the military hardware, is bought from somewhere else without basically increasing your local GDP. Actually is negative due to net exports. I guess in the end, until we get to an European single capital market, perhaps an M&A within the region of the capital markets could basically promote local capital and boost growth over the medium term.
Maciej, how do you see the cooperation in the region?
I will be quick on this one and will save some time to go back to the issues mentioned earlier by Geoff, actually, because I think it was very interesting. So I will go for competition on two aspects. I think competition for FDI, which was mentioned, and competition as well for migration. And I think the country developing the wise migration policy, which will cover the gap connected with demographics, will be very important going forward. And the cooperation, I think it's more on the EU sphere in the context of representing, how to say, the CEE region, and to be sure the mentioned Draghi report, to what extent the competitiveness policies of the Europe are representative for the developed Europe countries, or to what extent this is important for the CEE. And on the point Geoff mentioned earlier, the first point you said about to what extent labor will be replaced by capital and the productivity gains. I think this is not only hope, I think this is rational to expect this, that the companies will switch into more investments. And I'm not in this innovation camp. I would like to see high value added, high technology, more R&D spending, etc., etc. But before that, I think in the region there is still a lot of space for imitation simply of what happened in other parts of the world, which may boost the productivity quite significantly. One example, the recent report on the world automation in the manufacturing sector. The number of manufacturing robots per 10,000 employees in manufacturing sector. Korea, 1,000. Germany, half of that, less than 500. Czech Republic and Slovakia, half of that, 200 something. Poland, and I think Romania is roughly the same, below 100. So the level to reach the productivity gains and replace this cheap labor, let's say, I think is enormous. And the companies, well, this is not only about the new FDI flow, this is about the current FDI and the current investment already in the countries, how they will perform going forward.
Maybe I could just follow up. I mean, there's a fascination right now with things like venture capital and innovation, and this is great, and I think a lot of that should happen. But I just want to underscore Maciej's point, which is, I mean, it is much harder to innovate and come up with an entirely new technology within Central and Eastern Europe than either transferring the technology of abroad or just the practices of how to organize firms. And there is still enormous scope for Central and Eastern Europe to do that. Now, that said, that approach, the FDI approach, is part of why this region does not have as many of its own brands. I mean, Korea's approach had much more reliance on research and development funded domestically than foreign direct investment, and that does get more brands homegrown. But it's not an easy strategy to get to work. You can also get white elephants, and it's not the only strategy. And so I sometimes fear that the region is turning its back on FDI, when in point of fact there's still enormous room for productivity gains from this angle.
Thank you. We have 4 minutes left, so like 1 minute for each of you guys to sum up our discussion. So what are the biggest risk for further growth of the region and the biggest opportunities? Maybe we can sum up in that way, starting from Ciprian maybe.
Well, the biggest risk, I think, basically, if we look back, EU funds as a percentage point of GDP were much larger, and going forward, basically, they are going to be like between 1.5 and 2 percentage points of GDP, almost half they have been over the past 10 years, and EU funds have been an important growth driver. I think the other risk, it's related to geopolitics and companies not investing, fearing the proximity of war. And the opportunities are still, in the end, rather related with some competitiveness, though it has been eroded in terms of labor costs.
Maciej, what are the biggest risks? You already said the German economy.
Yes, and I think this is the biggest risk, that the stagnation in Germany will be prolonged. And for some countries, this means big problems because of the no diversification, very much focus on Germany and very much focus in one particular sector, automotive, and Czech Republic is a good example here. In some countries, like Poland, for example, there is a much more diversification, but I think to address this risk, this is about export diversification going forward, which is not easy to be achieved in the very short period of time, but I think this should be the target for for the region. I would put actually the EU funds in the opportunity camp and chances rather than the threats, because I think this will be the driver of investment growth in the next couple of years. The challenge is demographics, of course, but overall I'm optimistic, so I'm on the positive camp. And the energy transition, I think this is a big opportunity. Of course, if not addressed well, it may turn out that some companies may be out of the global value chain because of the carbon footprint, etc. But here I think we'll be successful as a region.
That's an interesting point that you see it as an opportunity, not the risk. Nina, what's your opinion?
So I will wrap up with the point that I mentioned in the beginning of the panel. That's twin transition, meaning digital and green transition happening at the same time. For some countries, it will be more challenging because they have lower share of renewables. Much of the green transition is really about the energy transition. So some countries have actually below 20% of renewables in their production of energy. But what could be potential of growth, but also potential downgrade, is that some regions in CEE economies are agriculturally based. And the research says that agriculture-based regions, the regions on the border, for instance, of Romania in particular, will not benefit much from digital and green transition. Unlike regions that are more concentrated on foreign direct investments, that have more high-tech sectors, export performance, like Czechia, for instance, some parts of Czechia. So if we look at the regions within these economies separately, there is a lot of diversification there. And there is a risk of greater gap within these economies, meaning that some metropolitan, FDI-driven regions, high-tech-driven regions will really catch up faster, but some will lag behind. And also that's further policy application for EU cohesion policy. But overall, not to land it on a negative note, I am very optimistic, and I think the future holds positive note. Yes.
Geoff, are you optimistic as well?
I think optimism is a choice. I choose to be optimistic, but I think we have a lot of tough things. I'd say that, to use a football metaphor, I think we have a tougher opponent and we are scoring own goals. The tougher opponent is the fact that productivity gains are getting harder. There's less easy stuff to invent, and we see that in the productivity data. We also don't have the access to huge pools of labor that haven't been used before. We don't have as much room to improve on female labor participation by having equality in the workforce. So those relatively easier gains are behind us, which is going to make things harder. And this is the point in the conversation when we normally say AI will save us, and I hope so. But I think that part is getting harder. And then the own goal is clearly the fragmentation and the geopolitical risk. I worry that we're entering a period more like the interwar period, when everything was turning inwards and we had less of the free movement of goods, people, and capital. And then we're moving away from what has worked for the last 70 years in much of the world and the last 30 years in this part of the world, which is kind of much more of this free movement. And I think we're underestimating how hard that will be. I mean, this region has been driven by export-led growth. And in a world when there's that much fragmentation, global growth will be lower, and this region will not be spared in that situation. It will be very difficult. So I'm hoping that we can put policies on a better track.
Let's keep fingers crossed for that. Thank you very much for a lovely discussion.